All right, welcome back. Today, we're diving into one of the weirdest corners of property tax law, this idea that you can be taxed on rent that you never actually got. Sounds totally impossible, right? Well, it's very, very real, and we're going to break down exactly how this phantom rent thing works.
So let's just get right to the heart of the puzzle. Imagine this. Can the government legally tax you for rent that, well, never even showed up in your bank account? I mean, it goes against everything you think is logical. But, and this is the crazy part, the answer is a definite yes. And we're about to see how the tax code pulls it off.
So, here's our game plan for cracking this case. First up, we're going to dig into the logic behind this whole phantom tax idea. Then we'll find the master key to all of this, a little something called annual value. After that, we'll see how the rules completely change based on whether a house is rented, if you live in it, or if it's just sitting empty. Then, we'll crunch some numbers. And finally, we'll wrap it all up with the key things you absolutely need to remember.
Okay, let's jump into our first section, the phantom rent tax. So, what's the core idea here? It's pretty simple, actually, but it changes everything. The secret is that the tax isn't really about the money you get. It's about the money your property could get. It's all about potential. And this right here, this is the legal bedrock for the whole thing. It comes from Section 22 of the tax code. It says the tax is based on something called the annual value of a property. But here's the absolute kicker. The tax is triggered simply by owning the property, not by whether you're actually collecting rent. So even if the house is totally empty, if your name's on the deed, the taxman could come knocking. Okay, so that leads to the million-dollar question, right? If the entire tax hinges on this annual value, what in the world is it? Understanding this one term is the key to unlocking this whole thing. So simply put, annual value is the government's estimate of your property's earning power. Think of it like a rental sticker price. It's the benchmark rent that the tax folks believe your property could fetch on the open market over a year. It doesn't matter if it's rented or not. This is its potential. So how do they even come up with this number? Well, it's not just random. There's a clear 3-step formula to figure out something called expected rent. Okay, step 1. You look at the municipal value and the fair rent for your property. You just pick whichever one's higher. Easy enough. Step 2. You take that number and compare it to the standard rent, if one applies in your area. And finally, step 3, your expected rent is the lower of the two values from that last comparison. It's basically a system of checks and balances to land on a fair number. And here is where it all comes together. This is the final showdown. The government takes that expected rent we just figured out, and they put it head-to-head with the rent you actually collected. Your gross annual value, the famous GAV, is whichever one of those is higher. See what they did there? This is how they make sure you're always taxed on at least what your property is capable of earning. All right, moving on. Now, these rules aren't a one-size-fits-all kind of deal. Not at all. How they apply to you depends entirely on how you use your property. Is it rented out? Do you live there? Or is it just sitting empty? Each one has a different set of rules. This little table breaks it down perfectly. So look, if you live in your own house, it's considered self-occupied, or SOP. The annual value, a nice big 0, so no tax. That's great. If you rent it out, it's a let-out property, or LOP, and yeah, that's taxable. That makes sense. But here's where the phantom rent tax really bites. If you own a second home and it's vacant, the law basically pretends it's rented out. They call it deemed let out, and you get taxed on that notional or imaginary rent, even if you didn't make a single rupee from it all year. And you've got to see this because this is a huge difference. When we talk about deducting the interest you pay on a home loan, the rules are like night and day. For the home you actually live in, that SOP, you can only deduct up to 2 lakh rupees of interest. But for a property you're renting out, get this, there is no limit at all. You can deduct the whole amount. This is like a cornerstone of property investment strategy. Okay, theory time is over. We've got all the building blocks in place. So now, let's get our hands dirty and actually do the math. We're going to see how all these rules and concepts come together to create a final tax number. So let's work through an example. We'll start with our gross annual value, the GAV. Remember how we got that? It's the higher of the expected rent and the actual rent. So for this property, let's say that number is 1,55,000 rupees. This is our starting line. Okay, step 2, we get to subtract something.
We can deduct any municipal taxes the owner actually paid that year. In our case, that's 10,000 rupees. So we take our GAV, subtract the 10,000, and that brings us down to our net annual value, or NAV, of 1,45,000.
Now for the big deductions. From that net annual value, we get to subtract two major things. First, you get a standard flat 30% deduction for things like maintenance and repairs. And it doesn't even matter what you really spent, which is kind of nice. Second, you deduct whatever interest you paid on the home loan that year. So, after you take out both of those, what are we left with? Our final taxable income from this house, 76,500 rupees. And that's how you get to the final number. And there you have it. The puzzle is solved. For our last section, let's quickly touch on what happens when things go the other way, when you have a loss. And then we'll do a lightning round recap of the absolute must-know rules. But what happens if your deductions, especially if you have a massive home loan, are actually more than your gross annual value? Well, that creates a loss on paper. And let me tell you, this loss is a seriously powerful tool. You can take that loss, up to 2 lakh rupees, and use it to wipe out other taxable income, like from your salary. And if the loss is even bigger than that, you can carry the rest forward for up to 8 years. It can literally turn your property into a tax-saving machine.
All right, so let's boil it all down. What do you absolutely need to remember? 1. Taxes tied to ownership, not just rent checks. 2. Annual value is all about potential, not just what you actually earn. 3. You get a free pass on one property you live in. Its annual value is nil. 4. That second vacant home, that's where you get hit with the deemed or phantom rent tax. And 5, don't forget the huge difference in loan interest deductions, capped at 2 lakh for the house you live in, but totally unlimited for a rental. And that leaves us with one final thought to chew on. Remember that flat 30% deduction for maintenance? It's simple, no doubt. But is it really fair? Think about it. The person with a brand new apartment gets the exact same tax break as someone struggling to keep a 50-year-old house from falling apart. It kind of makes you wonder about the trade-offs the tax system makes between what's easy and what's truly equitable. Something to think about. Thanks for tuning in.